So the recording starting. This is the one before the last meeting that we're going to have for this course. This will be the exam preparation, purely exam preparation. And obviously, if you have questions, you can ask me those questions. So now for the exam. Again, for the exam, you're going to have 300 minutes. On the exam, you're going to have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 questions. So there will be 12 questions. I'm going to write down for myself as well, so we can all have the same information. So in total, there will be, not the total, though, that will be 12 questions for which you have to do some calculations. And after that, there will be 4 multiple choice questions on chapter 12. 4 multiple choice questions there. On chapter 11, there will be 3 multiple choice questions. On chapter 10, there will be 4 multiple choice questions. On chapter 8, will be 3 multiple choice questions. And on chapter 9, there will be 5 multiple choice questions. So the most multiple choice questions, you're going to get it from chapter 5. So that's give us 19 multiple choice questions. Just a second, I'm missing one question here. In total, there are 32 questions. So for chapter 8, you're going to have 2 questions for which you have to do something. On the variable costing and absorption costing, we're going to start doing the exercises today. So we're going to go to those type of questions. On chapter 11, you're going to have 2 multiple choice questions. Not 2 multiple, 2 questions that you have to do besides the multiple choice questions. On chapter 12, you're going to have 2 I see here, but let me see if there's more. So in chapter 2, you're going to have in total 5 multiple choice questions. That's where it is. In chapter 12, you're going to have 5 multiple choice questions. So you're going to have 20 multiple choice questions and 12 other questions. So let's start with the questions. So there will be question 4. I want you to prepare me the flexible budget. I'm going to show you how to prepare the flexible budget. Most likely, I'm going to show you this. This question is going to stay for the next time, not this time. I want you to show me that you know how to do the fixed overhead variances. So we're going to practice on the fixed overhead variances. I want to show me that you can do the labor and variable manufacturing overhead variances. Again, we're going to practice on this. I want to show me that you can make decision when it comes for the make versus buy. Should I make it or should I buy it? Also, I want to show me that you can do a schedule for the expected cash collection. That shouldn't be that difficult for you. I would like to show me that you can do the sales. Should I sell it now or should I process it for the decision? I wanted to show me that you understand how to utilize constraints. Then I want you to show me that you can evaluate investment using the return on investment and the residual income. I want you to show me that you understand that decentralization and responsibility centers. So there will be a question that's going to give you example for the what's happening in this situation. So you have to identify, is this a cost center? Is it a profit center? Is it investment center? What exactly is? Then material labor variance. And the last two questions will be on the variable and absorption costing. So let's start one after another with the questions. Again, don't get scared. The questions seems like a lot, but they're not that many actually if you look. And for the time that you have, you should be able to finish them all. Again, I'm gonna stay as long as you have to stay, as long as you finish the questions. So try to make it a balanced exam. Every chapter to be tested to pretty much the same kind of extent. Not one chapter to dominate the exam. All the information to be spread through the chapters. And again, we're gonna prepare for those. So let's start with the first one. First thing first. So what I'm going to do, I'm going to start with variable earned absorption today, and we're going to move to the variances, and we're going to keep going until we cover all the questions that you can see on the final exam. The answers that the way I'm going to present these questions will be in terms of the Excel spreadsheet. And on the Excel spreadsheet, we're going to do the calculations. So if you remember, I told you on the final exam, yes, you're going to use the computer, which is in the classroom. That's the whole point. You to be in the environment which is close to the exam environment. However, you can bring your laptop. And if you can use your laptop for some additional calculations, anything like that, or some calculation that you may have from the assignments, that's totally fine. So that gives you a lot of opportunity once you know that you can use your laptop. But if you don't bring your laptop, then you won't be able to use that additional resource. Again, the other thing is if you decide to bring your laptop, make sure you have a Wi-Fi and Wi-Fi connection. Otherwise, you won't be able to use it to the full extent, if you understand what I'm trying to say. And that will be all for that. So now let's go with the questions. I'm going to start sharing my screen, and we're going to start going through questions 1, 2, 3, and keep going until we cover all the questions that I'm planning to give you. There will be 12 questions that's going to look something like this. Now we're going to cover more than 12 questions, definitely. Today I prepared for you 7. So next time we're going to, we may go more than 7 questions. We'll see how it goes. And next time more, until you tell me that you're sick of those questions and you're perfectly fine with the questions. Before we continue that, I saw that there's a lot of emails about the assignment. Is there anyone who hasn't submitted the assignment? If you haven't submitted your assignment, now is your time to tell me or send me something.
For the submission, because you said it was to submit to Blackboard, but there was no link. I think everyone emailed it to you.
Oh, that was the one. Okay, then the submission is gonna be, when was the submission? Today or
The submission was last night at midnight, and I mean, we
there was no?
messaged you, but you were away doing probably
Okay,
hospital things. But there was
okay,
no submission in Blackboard like available unless we
okay,
messaged it to you.
okay.
So I think a
Uh,
lot of groups just emailed it to you.
right, probably. So the other question is, are you done with the case? Everybody get done with the case. Is there anyone who haven't done the case yet? Is there any group that haven't done the case yet? There's no such a group. Okay, so I'm gonna create right now a submission for that case. Just give me a second, and you'll be able to submit it. And I'm gonna give you a case submission. I'm gonna open it till tomorrow. Okay, it's gonna stay till tomorrow open. But I want you to submit it in Blackboard tomorrow morning to 11:59. And you're allowed to submit one attempt. And let me see what else. What else I can have here available?
Just to ask a clarification
Yes.
on the case where it said the company purchased assets at a cost of 300,000 for the office, and then it said it purchased them in January 2nd, 2024. Is that a typo and supposed to be 2025 instead?
Yeah, it can be 2025. Yeah,
Okay,
that was a mistake.
all good.
Yeah. So I'm gonna leave it so everybody can. I'm gonna leave it the submission in the form of like everybody can submit it. So it's not gonna be like by groups. Close by. It's not gonna be. I'm not gonna put any options for the group because you guys choosing your groups. So if more than one person work on the case, then you have to submit only one, and I'm gonna see which are the other people, and I'll make sure that I have everybody on the list. So the submission is in Blackboard now. Can you please check? I'll show you where I just posted, and you tell me if you guys can actually see it. It's right under the case material, case submission April 8, 2025.
You can see it. It's there.
Yeah, use this link to make a submission, please. So again, if you're working more than one student working on the case, only one person can submit it. You don't have to submit all two of you or three of you or four of you that working on that case. You don't have to submit all of those. Okay. Okay, let's go back to our case work on the questions. So the first question today will be about for chapter 8 on the absorption and variable costing. So this company, can you guys see my screen?
Yep.
Okay, this company manufactures and sells single product. The following the costs which happened during the first year of operation. So when you see first year of operation, what that means to you? That means that there's no beginning inventory balance. So whatever they did in this year, that's what the only thing they did. So the other thing that you can think is, okay, we're going to see this information about the variable cost per unit. We're going to see the fixed cost for the year. That's perfect. The next thing that when we see the fixed cost in total, the next thing that I want you to think is for what kind of production level this cost is applicable to. So that means is $300,000 is the fixed cost, but on one production, what's the level of production? And then you can see what's the level of production. The other thing that you can think is, since it's the first year of operation, and you're doing the variable versus absorption, you already know that if the beginning balance is zero, then the next thing that comes to play is production versus sales. If the production is more than the sales, then naturally absorption costing is going to give you high income. That's the only thing that you can think. The other thing is if it's the first year of operation is my production is equal to my sales, then there will be no difference between both systems. But that's never going to be the case because that kills all the joy of testing students. Make sense? So don't look at the question as a question. Try to analyze the question. Try to think what you can get before you even start to getting something. That's why I want you to be. Don't look at the question something that, oh my God, what I'm going to do here. Look at like a challenge. Okay, what can I get before I even start? How to think, how to adjust my mindset in order to get the most valuable for me to solve the problem. The next thing that once you can briefly see this information. The next thing that you can jump to the requirement and think, okay, for this requirement, what kind of information I need? For that requirement, what kind of information I need? So first one is assume the company using absorption costing. What that means that they have to, of all the costs that they have here variable, they have to absorb something else. What will be that? That will be the fixed manufacturing overhead. So for that reason, I need the fixed manufacturing overhead per unit. How can I get it per unit? Once, if I have the total amount, well, I'm going to see how many units the production was divided by that number is going to get it per unit, right? And then compute the unit product cost and prepare the income statement for the year. And the second one is assume the company using the variable costing, compute the unit product cost and prepare income statement. Seems like a very straightforward question. The only thing that we have to do at this point is, once we have this information, is to get the fixed cost, only the fixed manufacturing overhead per unit, since we have it in total. So what we're going to get those 25,000 here. I have my production is 25,000. And what I'm going to do, I'm going to get this 300,000 divided by 25,000. I'm going to get that my the fixed manufacturing overhead is actually $12 per unit. So at this point, I have everything that I need. So what I'm going to do, I'm going to get this information, entire information, copy it, and I'm going to move it here. And then I'm going to start working. First will be my absorption. And the second one will be my variable. Make sense? So the question is, what I'm chasing? I'm chasing product cost. It's very important for you to understand what we have to do. I'm chasing the product cost. So what's in the product cost? Can somebody tell me what is in the product cost? Product cost is equal to what?
Direct materials, direct labor.
Direct material plus direct labor plus
think it's the variable manufacturing
let's
overhead.
call it manufacturing overhead. Generally, is manufacturing overhead. Now, for the purpose of the questions that we're doing and for the purpose of the further analyzing the information, we broke that manufacturing overhead into the two components, right? Now we can say the variable manufacturing overhead is equal to the variable manufacturing overhead plus the fixed manufacturing overhead. But in reality, that's total is manufacturing overhead, which is part of the product cost. So now, for that reason, what do we need? We need direct material, right? We need direct material in both systems. We need direct labor. Do we need variable manufacturing overhead?
Yes.
Yes, it's part of the overhead. Yes, we need this one. Do I need variable selling administrative expenses?
No.
No. Is this part of the product cost? No. That's actually period cost. What else I need? Fixed manufacturing overhead, right?
Yep.
But if I go with the total, is that going to solve my problem? No. Right? So where I have to go, I have to stay on the level of 1 unit. And this one will disappear. I don't need this information. How about the fixed selling administrative expenses? Do I need it for the product cost?
No.
No. Now, what's the difference between variable and fixed? What's the only difference between variable and fixed?
One of them doesn't change based on how much you sell, and one of them does.
Okay, that's in the general thing. But one of them, before we go down, we just chasing the product cost at this point, right? We're chasing only the product cost. What's the difference in the product cost between one and the other?
The fixed one goes down the more product that you have.
So the unit product cost. So what's the difference between? Absorption is going to absorb the fixed manufacturing overhead. And my cost here will be $27. Can you guys see it? How about the variable? Is it going to be the same?
No.
No. Which one we're going to miss here in the variable?
Fixed
manufacturing
overhead.
Fixed manufacturing. Why? Because it's fixed manufacturing. We don't care about the fixed cost. We only care about the variable cost, which is direct material, direct labor, variable overhead cost. So that's our difference here. Now, the next thing that we have to do, we have to prepare the income statement. So basically, with this calculation here, I simply cover this requirement and I cover that requirement. So how much is my unit product cost using the absorption? $27. How about variable? If I'm using variable, how much is my product cost?
15.
$15. Can you guys see it?
Yeah.
Do you understand how we get it?
Yes.
Yeah.
Perfect. So now, from now, what we have to do, we have to prepare the income statement. The good thing is, why I'm pushing you to do the income statement, because technically you just have to choose some things, elements from which are already given to you. So you don't have to prepare the income statement from scratch, which I'm going to do now. It's already given to you. You just have to, push the arrow down and choose the right elements. So which element, every income statement starts with? Obviously, name of the company, name of the company first. Don't forget, every statement starts with the name of the company. Second thing is the name of the statement. Third thing is we prepare an income statement for the period of time. What's the period of time? After that, we start with sales. So I'm going to skip the first 3 points. I'm going to go with the sales. And Under the both system, we're going to have cells. Try to do it parallel so you can see the difference between one and the other. Okay, we get the cells. What's the next thing? Absorption. Means on absorption, we're going to the traditional income statement. Do you understand that? If we're doing the absorption, we have to go to the traditional income statement. What's the next thing on traditional income statement?
COGS.
Sorry?
Awesome.
Sorry? Traditional income statement, people. What's the next thing?
Cost of goods sold.
Thank you. That's all. Cost of goods sold. Nothing more, nothing less. So, cost of goods sold. Now, can I easily get my cost of goods sold? Obviously not.
Yeah.
We have to calculate it, right?
Yeah.
How are we going to calculate it? By using the same, let me format those one to be the same format. So what I'm going to start? I'm going to start here with beginning balance of my inventory, right? Then I'm going to add my production, or that will be cost of goods manufactured. And then what I'm going to do? I'm going to deduct. Then we're going to have available. Those here will be called available. Then I'm going to have less
And
ending balance of the inventory, or that will be finished goods in this case. Let's go with finished goods, not inventory, even though finished goods is inventory as well. Let's stay with the right terminology, finished goods. And once we get those, I should naturally get cost of goods sold. Make sense? After get cost of goods sold, what's the next thing?
gross margin.
Gross margin. Again, I'm on the traditional income statement, getting the gross margin. Once I get the gross margin, what do I have to do? See if there's any operating expenses. In this case, do I have operating expenses? Yes, I do. I have selling and administrative expenses, variable and fixed. That will be here. Let's copy those one. So value here, variable administrative expenses. And the next thing is the selling and administrative expenses. And we are done with our traditional income statement. Make sense?
Yes.
Once I get
Yes.
those two, I'm going to get my total, and my last thing is my operating income. Or operating income in this case. I don't want it there, I want it right here in the beginning. And we're done. Now, in this case, what we're going to start? We're starting with sales. I'm going to put the numbers a little bit later. Next thing, what I'm chasing, next thing. Variable cost. But variable cost of what? Of my cost of goods sold. But now I'm the variable thing. I'm not on the fix. Sorry, not on the traditional. So what I'm going to start? Pretty much the same thing. So I can easily copy this and paste it here. That's not going to change. And I'm going to get the variable cost of my cost of goods sold. Am I done with the variable cost though? Not yet. What do I need? My variable selling and administrative expenses. Once I get my variable portion of selling administrative expenses, then I can say, okay, I'm done with this. Then I can get the variable cost. Once I get the variable cost, what's the next thing that I have to do? Actually, I don't want to cancel this one. I want to keep it this one. Once I get those one, what's the next first calculation for me here?
Contribution margin.
Contribution margin. Contribution margin here. Once I get the contribution margin, what's left?
Fixed costs.
Fixed cost. How many fixed costs I have? Those two.
2.
Right? Gonna get this two. Gonna paste them here. And I'm gonna formatting to be this way. And after that, I'm gonna have my operating income. Correct? Now that's pretty much the logic of all things. Now we can start putting the numbers. Sales, how many we sold? 20,000. What's my selling price?
50.
50. So my sales are 20,000 units times $50. We can easily get our sales, and our sales will be equal to 20,000 times $50 per unit. It's gonna be that number, 1 million. So how this sales gonna be different than the other sales? Is it gonna be different?
No.
No, it's
No.
gonna be exactly the same. So I can easily copy and paste it and go on the other side. Okay, so I have my first thing. What's the next thing that I have to do? Cost of goods sold. And start with the beginning balance. How much is beginning balance? 0,
Zero.
right? Starting with 0 and keep going, keep going, keep going until we get the number. That will be 0, not all. Oh, those should be number. Now, production. How many we produce? We produce 25, correct?
Yeah.
So our production here will be 25,000. What's my production price? Product price, $27, correct?
Yes.
25,000, 1, 2, 3 times this $27. And we're gonna get my production. Too big, like something like this. How this gonna change on the other side? My beginning balance here will be 0, correct?
Yeah.
How about production? Is the number of the units gonna change?
No.
No, but my production price is gonna be different, correct?
Yep.
Why? Because I'm producing 25,000, but my product price now is only $15. So that's my first change here on my production. Let's make it a little bit bigger. Oh no, let's move it to, let's grab this one and format those cells to be the same. I like this formatting here, which doesn't have the zeros. Okay, so the next one, those two gonna give us available, that's calculation. We don't have to do anything crazy here. Available is just calculation. And the next number that we need is the ending balance. How is our ending balance? If we produce 25, but we sell only 20, our ending balance will be 5,000, right?
Yes.
But 5,000 times
27.
27. Or let's go with here, 27 here. And we're going to get ending balance. So that means my cost of goods sold are equal to this one minus what's my ending balance is. That's my now cost of goods sold. After those, I can get my gross margin, which will be equal to my sales minus the cost of goods sold. Now, what's going to happen in this company here, in this scenario here? Available, again, it's going to be calculation between those two numbers. So we get this calculation. Let's formatting this 0 to be 0 here. Then we're going to have less finished goods, which is in this case only 5,000. Ending balance of the finished goods 5,000. So I have to deduct here. That will be equal to 5,000 times only $15. So my cost of goods sold, variable cost of goods sold here is this one minus that one. My cost of goods sold here are only $300,000. So as you can see now, we start developing that difference of how much is the difference? $240,000. Can you see it?
Yep.
Now the question that's on the cost of goods sold. How about the ending balance? We have a difference about 60,000,
Yeah. Yes.
right? Why 60,000? Because we have here a difference of how much is my variable cost? Sorry, fixed. What's the difference between those two? Only the fixed manufacturing overhead, which is $12. How much is my ending balance? 5,000. So 5,000 times 12, does it give me 60,000?
Yes.
Yes,
Yes.
that's from where the difference comes. So once we know that number, do I know how much should I expect to be difference between operating income absorption and the variable? We already know that. So
60,000.
60,000. So let's see if that's going to check. Let's go first with the variable semi-administrative expenses. Those will be equal to 20,000 that we're selling time how much was that? $4. So we get those $80,000. Let's formatting to be this way. We get our $80,000 here. Fixed semi-administrative expenses. Those going to be equal directly to the number here, 190,000. So our operating income here will be 460 minus 80 and minus 190. So it's going to be $190,000 in this case. Let's put the dollar sign at the front, put the dollar sign at the front here, double line it, and that's our income statement right here. So let's see what's going to happen on the other scenario here. We still got to get the variable administrative expenses, which will be exactly the same, which are in this statement, correct? There will be no difference on the same administrative expenses. It's going to be 20,000, the one that we're selling, time the $4, which is our same administrative expenses. So there will be no difference on that area. Now, from where the difference is gonna come? Because we have the fixed manufacturing overhead here, entire fixed manufacturing overhead, which in this case is $300,000. And once we get the $300,000 here, let me change something about these numbers because I don't like them. It's formatting them a little bit. This one here. This one will be like this, and this one will be like this. And the next number I have is exactly the same, 190,000 from here. So my operating income here will be, oh, we didn't calculate the contribution margin here. We missed that calculation. This one minus 300 minus 380. Contribution margin here is 620. And then we're going to have 620 minus 300 and minus 190. And we're going to get operating income of $130,000, which is exactly how much different?
60,000.
60,000. Where can we find these $60,000? They hold in our inventory ending balance. Make sense?
Mm-hmm.
So that will be one possible question that you may have on the final exam. So do you see anything scary in this question?
Is the question going to be like, make the whole sheet, or are we just looking for the difference or like the operating income of the end?
It might including to do this, but if you're including to do this, the only reason is because you don't have to type anything, right? You just have to plug the numbers. All the information about the cells, all those will be available for you. You just have to pick the right element on that category. You know
Okay.
what I mean? Yeah. That's the whole thing. That if I use a question like this, the only reason is because you have drop-down menu. The thing is I'm chasing here is to practice, just to practice the flow of information, nothing else. Other than that, you can easily come up with the conclusion that the difference should be fixed manufacturing overhead times the ending balance. This is this question. Let's go to the next question. Next question is again, but now we're going to have 2 years of operation. First 2 year of operation. So what that means? That means that the first year was 0, beginning balance. Second year we left over from the first year. And reported absorption costing, sales that much. Cost of goods sold that much. Gross margin this one. Sales and administrative expenses that much. Operating income that much. Now the sales and administrative expenses are $2 per unit, variable, and 130,000 fixed per year. That starts here, selling administrative expenses. The company, $18. Company's $18 unit product cost is computed by having direct material, direct labor, variable overhead, fixed manufacturing overhead. That's absorption costing. Now, production and cost data for the first 2 years operation are unit of production, 45, 45. So the unit of production stays the same. And what changes? Sales changes. Now, using the variable costing, what's the unit product cost for both years? Using the variable costing, net operating income in year 1 and year 2. And the next thing is to reconcile the absorption costing into the variable costing, net operating income figures for each year. So first thing first, let's get this information here. Let's place it here and let's deal with the first one. Since we're using the variable costing, what do we have to adjust for? First, do we have to adjust for something? And if we have to adjust for something, what will we have to adjust for?
We will have to take out the fixed manufacturing overhead.
So let's take it. So what's happening with our total cost?
Goes down.
Goes down. How much down? $12. In fact, $6 down. Correct? So we got the variable cost in the first year. How much will be the variable cost in the second year? Because we have to do it in the both years, correct?
It should be the manufacturing overhead of the second year divided by the units. So in year two,
Think
hold
about
on.
it. We already did exercises in class. Is there any changes in the variable costing from year to year?
No.
On the product cost? No.
No.
Why? Because the variable cost always stays the same. If there's a changes, that change is going to come only and only in absorption.
Yeah.
Why? Because and that's going to come only and only if the units produced changes. If the fixed cost is the same and the production doesn't change, then the fixed component of the variable cost of the manufacturing overheads is not going to change. It's going to be the same number. Make sense? And since we have in here the production is the same in the both periods, the only thing that it's going to start that's going to drive the difference will be the ending balance of the inventory. Nothing else. The cost per unit is going to both years going to stay the same. So what's the variable cost net operating income in year one and year two? So for the answer to answer this question, I can usually use this calculation, can I? And that's going to save us a lot of time. I can put this calculation here. Now what we have to do, we have to adjust. Make sense? So
Yes.
do I have my sales?
Yes.
Yes.
My sales is 1 million here. Because I'm selling how many I'm selling the first year? It doesn't
40,000.
say. Yeah, 40,000. So first year I'm selling 40,000. Let's adjust to those numbers. My selling price is 25. Half of the 50, 25. And that will be 40,000. Let's change this formula here. 40, 1, 2, 3 times 25. 1 million. The second year. Let's do the second year right away without wasting time. How my sales going to change compared to the variable cost compared to the absorption costing? Is it going to change?
Yes.
How? Sales, are they going to be the same or going to change?
Change.
Why? Is the salespeople, they shouldn't be changing. Make sense? We're not changing anything here. In the sales and the both system, it's going to be exactly the same. What's going to change? Only cost of goods sold and inventory. That's the only thing. So since we're selling 45,000 units, Here we're gonna sell 45,000 units,
We sell 50,000.
right? Is it 50? Yes, 50,
Yeah.
sorry.
Yeah.
40, yes, sorry, 50. 50,000 times 25 is gonna give us 50,000 units times
25.
$25. That's gonna give us 1,350,000. So there will be no change in the sales in both systems. Now let's go with the variable costing here. Beginning balance in the first year will be 0.
So
Production the first year. We produce
45.
45, right?
Yep.
Every year we're producing 45. 45. And that will be equal to 45,000. 1, 2, 3 times $12.
12.
540. Ending balance will be 5,000, obviously. And that will be 5,000 times
12.
$12. We're going to get sales administrative expenses. We have the portion sales administrative expenses was $2 per unit variable. So then we're going to have 40,000. 40,000 times $2.
82.
Then we have a fixed manufacturing overhead, which fixed manufacturing overhead, we already know how much is it, 270,000. Can you see it?
Yes.
So 270,000. And the last thing is sales administrative expenses fixed one, which is here 130,000. And we're done with our income. So what we can check is where is the operating income of the absorption? Is 70,000. Where is under the variable? 40,000. What's the difference? $30,000. Is that make sense? Well, the fixed overhead is $6. Ending balance is different. Ending balance is 5,000 units. 6 times 5, does it give us the difference?
Yep.
Yes.
Yes. Okay. So the next thing that we have to do here is pretty much the same, but now we have a beginning balance. Beginning balance is the ending balance, right? Dot 60 become here
Professor?
beginning balance. Yes.
Sorry, why did we multiply it by 5? The 6 into 5, the 30,000 difference. How did you got that? Sorry.
So here you see operating income here on the variable is 40,000.
Yeah.
Under the absorption is 70,000,
Yeah.
right? What was the rule? Every time when our production is more than the sales, absorption costing is going to give us high operating income than the variable. With how much?
Yes.
With how much? With the portion of the fixed manufacturing overhead times the number of the units left in the inventory. How many units we have more than our sales? Production is more than sales with 5,000 units, correct?
5,000. Okay.
Times $6,
30,000. Yep.
30,000. So that explains how we absorption we have 70,000, and the variable we have only 40,000. The $30,000 in absorption are held in our inventory, where in the variable are released through the fixed overhead, fixed manufacturing overhead, directly into the operating income. So now let's see what's going to happen the second year. Beginning balance will be ending balance on the first year. Production. Production we have to change here to 45, right? We're producing 45,000. And is the production numbers going to change? We're producing the same numbers, right?
Yeah.
So the production is going to be again 45,000 times $12 per unit. That's available. Ending balances since we're selling 50 here, we start with 5. Here we have 5,000. 3. Ending balance will be 0. Right? We don't have to worry in this case about the ending balance. So our ending balance is 0. That means all the inventory is gone. Variable selling administrative expenses, that will be equal to 50,000 times $2, I believe. That's 100. Fixed manufacturing overhead, we already have it, is equal to 270,000. And the fixed selling administrative expense is going to be the same. And here we have $150,000 operating income, which naturally should be $30,000 higher than absorption. Is that actually happening?
Yes.
Yes. So now, how are we going to do this reconciliation? Because the last thing that this question asks is reconcile the absorption costing and the variable costing net operating income figures for each year. So how are we going to do this? Well, very simple. What we have to do is get the 2 years, that will be year 1 and year 2. We're going to get the beginning inventory, which units sitting in the beginning inventory. Then we're going to get plus the units produced. Then we're going to have minus units sold. So what was the beginning inventory in the first year? It was 0. Then we
0.
produce
45.
45,000. Then we're going to sell only 40,
1,000.
right? 40,000. Those are the numbers for the first year. Then we're going to have unit in the ending inventory. Sorry. Trying to copy here something. Why it doesn't help me? Maybe that help. Because I need something on the top like this. So my ending inventory here, once I get those two, it's gonna be equal to beginning plus production minus sold,
6.
right? 5,000.
Right.
Next year is gonna be equal to the 5,000 plus production is 45. There's no changes in production. Sales are going to 50,000. And my ending balance is
Minus 5.
0, right? So I'm starting from 0 and finishing with 0. So now let's see, do the reconciliation, actual reconciliation. And that will be in the format of year 1 and year 2. How much is my fixed manufacturing overhead? Manufacturing overhead in ending inventory in the absorption. In the first year, the difference is those 5,000 times the $6, correct?
Is this amount just for the ending? Like
That's
the
the
in the
yes,
end, how much
yeah,
was left?
the ending inventory. That's the one that create that difference, right?
Okay.
But in the we don't have anything in the beginning inventory, so that will be 0 minus 0 here, and then we're gonna have this manufacturing overhead, a differential release from the inventory, and that in our case is $30,000 in the first year, where in the second year the fixed overhead, which is held in the inventory, was 0, but we have minus 30,000, which is coming from the previous year, and that drives the difference. That those two numbers give us the negative 30,000, which is the difference 1 year versus the other year. So if we have to compare the net income versus one and the other, if we have the net income, oh no, that will be operating income absorption. And operating income variable. Then the first year absorption give us operating income of 70,000, where the absorption give us operating income of 40,000. This number here will be the first one minus the second one. So in this case, the absorption give you the higher operating income difference, as you can see. But in the second year, the numbers change. In terms of the now absorption give you 120,000, where the variable is going to give you 150,000. So in the second case, the difference is 30,000, which difference comes from the inventory, fixed overhead, which is held in the inventory. Make sense?
Yes.
So the
Questions? Yes.
reconciliation,
Sorry?
sorry, the reconciliation that the third part wanted us to do, that just means that we show them the difference from the absorption and the variable.
So yes, that will be that show the difference, but the reconciliation also can be given this way. Now I can't remember how exactly the question is. I have to check and I have to see exactly how it is. But it might be also given this way: operating income versus the variable, and operating income versus the absorption. So no, it's not going to be this way. It's going to be absorption, Control C, Control V. And here we can have manufacturing overhead deferred in the inventory. And then we can have here on the variable costing, we have 40,000, right? The holding in the inventory is 30,000, which give you the absorption, which is going to be equal to beginning plus the variable plus. So from the variable costing, so once you get the variable costing, and when you add the manufacturing overhead deferral, which is in the inventory, it's going to give you the absorption. On the second year, if we start again with the variable costing, and then we're chasing the fixed overhead, which is released in the from the ending balance of the inventory, and we're gonna get the absorption costing income, which is 120. I would say this actually is the actual reconciliation because it shows you that exactly how one moved to another. This one is more like a from which one comes from. First, you have to understand is that every time
So,
when the production, sorry, yeah,
sorry. So in the
go for it.
connect questions, like which we'll get in the final exam,
Yes.
what will be the format it will ask us for? Like,
Yeah.
will it ask for?
Let me take a look.
Yeah.
Just a second. Let me take a look. Okay, the question is gonna ask you exactly for this. So the green one will be your thing that you're chasing. Okay.
So the difference that we get, we subtract that from the operating income from
Yeah.
variable.
Yeah. This is your reconciliation. This is actually your reconciliation here.
All right. Thank you.
So if I have to, so this will be more like a supporting calculation to come up with this reconciliation, but that will be your reconciliation here. And I'm gonna leave it the way it is, so you can know which one is it. Let's see another question. So those are the two type of questions that you might see as on those variable and fix. Sorry, variable absorption. Questions with this variable and absorption. Do you get the whole idea with the variable and absorption?
Mm-hmm.
One person say, how about the other?
Understood.
Understood?
Just one quick thing again.
Yes.
Again, when it comes to connect, will it be the similar formatting when it comes to when we make the whole income statement
No,
method?
the connect's gonna ask you probably for the final numbers.
The final numbers only.
The final numbers. In this type of question, it's gonna ask you for the type of final numbers. But the question is, can you come up with the final numbers?
Yeah.
Obviously, you should be able to come up with the final numbers.
Because this formatting sometimes, like when we have done the assignments, it's very silly errors that catches our marks. Like we by mistakenly put the wrong
Right.
account.
No,
This
it's
time
not
in
gonna
the
be.
final
So
assignment,
listen.
that won't be the issue.
So listen,
Right.
it's not gonna be of the. So on one of the questions, actually, is gonna ask you to put, but the level that you have to put will be the sales, cost of goods sold, gross margin, sales administrative expenses, operating income. So basically, there will be no calculation of the beginning balance plus ending balance plus this minus that, nothing like that. It's just going to be simply will be the calculation. Sales. So basically, the level of the calculation that you have to that you're going to experience in the question will be, let's stay with this question. For example, what you have to calculate this. You have to get directly this. You don't have to show this calculation here. How you get to the 540. So basically on your calculate on the connect, what you have to do is you have to show only this information. This information is not necessary. This, I'm gonna put it
All
in
right.
the purple. This one is not necessary. On this question, the only information that you need is this information. This information is not necessary. This is additional information to show you how to get the this element of the cost of goods sold on the variable, but that's not going to be asked you to show this calculation on the connect. Make sense? Only this information is required. Questions? If you don't have questions, let's move to the variances now. Enough with the variable absorption. I'm kind of, I don't know. What do you think about the variable absorption? It's not that super tricky. The only thing that you have to be careful is don't include the variable overheads in the calculation for the product cost for the variable costing. That's all. Let's go with this one. This company produces bird feeders made from the recycled plastic. Last month, company produced 600 feeders using 320 meters of the recycled plastic. The total cost of the plastic was 1,856. The company standard for one bird feeder is 0.5 meters of plastic at cost of $6 per meter. What cost for the plastic should have been incurred to make 600? Birds feeders first question. Second one, how much greater or less is this than the cost that was actually happened? And the last one is to break the differences into the material and variance. So how are we going to do this question? Well, I'm going to stay with the format that I show you, with the chart that I show in class, and just going to implement it here, which will be the actual quantity time actual price. And here I'm going to have actual quantity time standard price. And here I'm going to have 1, 2, 3 standard quantity times standard price. Can you guys see my screen?
Yes.
And I'm going to stay with this this format. Now, let's go one after another and start shopping for the information here. What do we need and what we don't need? Tell me, what do we need and what we don't need? First, do I know my actual quantity?
Yes.
So listen this. My production has nothing to do which variance we're doing here. From all the product costs variances that are available, which variance we're doing here? Again, which is the product cost?
The 1,856.
No. What's the product cost? Total product cost. Which is the three elements of the total product cost?
Direct material, direct labor, and manufacturing overhead.
So product cost is equal to direct material plus direct labor plus manufacturing overhead. And we said manufacturing overhead, we can break it, manufacturing overhead, we can break it to variable manufacturing overhead plus fixed manufacturing overhead. Correct? So now we have four possible variances: direct material, direct labor, variable overhead, fixed overhead. Which one we discussing here? So we have four possibilities: direct material variance, or we can have direct labor variance, or we can have variable overhead variance, or we can have fixed overhead variance. Which variance we chasing in this question?
Direct material.
Direct material. Is that clear for everybody? Okay, great. That's what I wanted to hear. So direct material. Quantity, so now when we say the quantity, that's not the quantity of the products that we produce, that's the quantity of the material that we actually use. So how much material we use?
320.
320 meters. And how much we pay for that?
1856.
We don't have it right now. We
1,856,
calculated.
right? So how much is my actual price per unit? Per meter?
5.9.
This one divided by that one.
320.
Is that what you guys getting?
It's
Right.
yeah.
580? Okay. So my standards, where are my our standards or this company standards? Standard price is
$6.
$6. Let's put dollar amount here. And now the actual quantity is 320. Standard price is equal to this $6. We're not going to change it. And then what we have in here, we should have a number here, which is this one time $6. And we're going to have 1,920. And the last number is we have to find out. I don't need that many, that's much separation between those. So what do I need here in order to get the standard quantity? I need my production, correct?
Yeah.
How much was my production?
600.
So my production is 600. Is 600. And based on my standards, how much I have to use for one?
0.5 meter.
0.5 meters is right here. Let's highlight it with red so we can see it. 0.5 time with time 0.5 meters. And that's going to give me number of
300.
300 meters times 0.5 per unit. That will be per unit here. So we get 300. So our number here will be 300 times $6. And we have our variances. Let's put some shapes here. Let's get one of those. Expand it a little bit just to make it nice. Go, we have the first variance and we have the second variance. Let's grab it here. Okay, how much my variance here will be that one minus this one.
64.
64, what will be that? Favorable or unfavorable?
Favorable.
Favorable. Why? Because the cost going down. How about here? Will be this one minus that one. Favorable or unfavorable?
Unfavorable.
Unfavorable.
Unfavorable. Cost going up, right? So,
Professor,
yes.
sorry to interrupt.
Yep.
Can you explain why we go for favorable and unfavorable, like again?
Why are we going? Or
Like why,
how?
how we decide favorable and unfavorable in the cases?
Okay, so it's very easy. You to process. Just a second. Let's get this one. That will be this one minus that one, right? That will be 56. So how are we getting it? So based on my standards, those are my standards, correct? based on my standards, we're supposed to spend $1,800. In reality, we're spending $8,056. Is that good for me or not good for me?
Not good.
Is it in my favor or is not in my favor?
Not in our favor.
So what will be, how much more we spending? $56. Is it going to be favorable or unfavorable in this case?
Unfavorable.
Unfavorable. Make sense?
Yep.
Same thing here. Based on our standards, by using the standard price, with to produce 600 units, we need to use 300 meters. In reality, we're using 320. Now, because of the change in the overusage of the material and material only, we have a variance, correct?
Yes.
Now the question is, how much is that variance? So in this case, my variance is 120. Now, because of the overusage, you see here, I'm using $20, 20 meters more. 20 meters times $6 is going to give me 120. I'm using more. Is it favorable or unfavorable for me?
Unfavorable.
Unfavorable. Why? Because I'm using more. Make sense? Now, if this here, if in reality I was using instead of 320, let's say I'm using 280, what's going to be? Is it going to be favorable or unfavorable now?
Favorable.
Favorable. So, but because we're using 320 more material, if you're using more material, the cost is higher.
Understood.
Yes,
Thank you.
in reality, the price per material went down, but we're still using more materials. So we're losing more from the overusing the materials rather than saving from the lower price. Another way you can look at this is very simple. Imagine this. There always, how can I say, there always this element of which one to buy, especially when you go to the grocery store. Especially when you have, there's a section of the groceries, let's say in the vegetable section, there are always vegetables which are reduced to 50%, correct? Are you guys with me?
Yep.
Yes.
Yes.
So now,
Yeah.
imagine this. You have bag of 10-pound potato sitting on the regular price, which is $8. And you have the same bag potato with $8, but reduced on 50%. Why? Because there's something wrong with those potato inside. Now the question is, when you get those potatoes on the 50% less cheaper with $4, would you save money or not? In other words, when you get the $8 potato, when you peel the potato, how many dishes you can make? When you get the bag for the $4 that you buy, when you peel the potato and you just get to the actual potato that you can actually using for the dishes, how many dishes you can make? If it turns out that with that bag which is half price, but you can make a way less dishes because of the rotten potato inside, you have to peel them more, the amount of the actual potato is getting less than on the regular price, then you, in fact, yeah, you're thinking that you're saving money, but in fact, you're losing money. Why? Because the quantity now is not there. Does that make sense?
Yes.
Yes.
So this is the interesting approach. Yes, you're buying cheaper, but do you actually saving money? Because yes, you can see the cheaper price, but after that, you don't follow the process to see is that cheaper price actually bring and give you more production or the same amount production. If you give you the same amount production, which is the regular price, then yes, you're clearly saving money. But if in the half price you can make a half of the dishes that you're making on the regular price, you're not saving anything. In fact, you may actually losing money. That's an interesting thing that I want you to think about it. Let's move to another of those. So here we have a different question. Let's see how many variances we have to do here. This provides a high in-flight news to a number of major airlines. One of the company products is stuffed cannelloni with the roasted pepper sauce, fresh baby corn, and spring salad. My goodness. During the most recent week, the company prepared 6,000 of those meals using 1,150 direct labor hours. The company paid these direct labor hours worker 70,250 or $15 per hour. According to the standard costing for this meal, should require 0.2 direct labor hours at cost of $14 per hour. So again, direct labor cost. So from all the variances, so let's go back to the first point. We have to first identify which variance we're doing. It's very important you to identify in the very beginning. Out of possibility, we have direct material, direct labor, variable overhead, fixed overhead. Which one are we doing?
Direct labor.
Direct labor clearly. Is it clear for everybody?
Yes.
Okay, then let's go with this. Now we have to change the terminology. I'm going to use this as a guidance, but I'm going to change the terminology. Here, we're not going to start with the actual quantity. We're going to have actual hours. And it's not going to be price, it's going to be actual rate. Rate that we're paying. Then we're going to have here actual hours time standard rate. And the last one will be standard hours times standard rate. And now we move to the labor. Now let's see where the actual numbers. Let's increase a little bit those cells like this. Where are our actual numbers?
1,150.
1,150, yes. So we have actual hours, 1,150 hours work. For those hours, I want to increase this number a little bit bigger so you can guys see it. It doesn't change the way you see it when they make the numbers bigger. Or does it make any difference? How is it? Can you tell me, give me feedback, please? When I increase the size here of the font, doesn't make difference on you when you see it on the screen in Zoom? Or it doesn't matter?
I'm sorry.
It's good.
It's good? Okay. So what's the actual rate here? We can see the total cost. Let's go with the cost. 70,000. They paid in total $70,250. That's how much they pay. and from here, once we have how much they pay, we can easily come up with the actual rate, which will be the dollar amount divided by total hours. And we get that one. So, and we know that they paying $14, $15 in this case. So the actual hours, we're gonna get it from here. Now the next thing that we need is standard rate. Standard rate, based on our standards, we're supposed to pay
14.
$14. Let's pay those $14 and let's see what's gonna happen now. If we producing based on our standards to make this production to using 1,150, we're supposed to pay this one times $14. We're supposed to pay only $16,100. So in reality, we're paying $72.50. Is that in our favor or is against us? What you gonna say? Is this favorable for us or unfavorable?
Unfavorable.
Unfavorable. Why? Because we overspending. And in fact, how much we overspending? 16,100 minus 175. We spent once overspending $1,150. Is that make sense? When you see the number, is that make sense? Is this number make sense?
Yes.
Yes.
From where
Yeah.
that comes from? $1 difference, 1,150 hours, $1,150. Simple, right? This one is right in front of you now. So let's see on the standards. What's our production?
6,000.
In our production was 6,000 meals. Now, how much, based on our standards, how much we supposed to spend per meal?
0.20. Net.
0.20 hours. So how many hours we need based on our standards then? We need 6,000 times 0.2 hours. We need only 1,200 hours. And the standard rate is standard rate. So where we are here? I want to change this to dollar amount. And where is, based on our standards, how much we're supposed to spend? We're supposed to spend $16,800. But producing those meals, how much we spent?
16,100.
So where that brings us? This one minus
700 favorable.
700 favorable. Why is favorable? Because we're using less hours. Make sense?
Yes.
And because we're using less hours to produce those meals, we have this favorable variance. Now on the big scale, on the spending variance, where we are? On the total spending variance. Are we overspending in total or underspending?
Overspending. Overspending.
Overspending. Is that favorable or unfavorable for us?
Unfavorable.
Unfavorable. Everything which is overspending is unfavorable. Remember it. It's not in our favor. We prefer to be on the other way. So that's one thing. Now, in this course, we're doing only cost and nothing else. Now, for those of you who are going to move to the intermediate, you're going to see now when you start working with the cells, then it's a different story. So here in the cost, when the cost increase, that's unfavorable. But when you're looking for the point of sales, if the sales increase, that's better for us. Make sense? Are you guys with me?
Yes.
Yes.
So imagine this. Now this is a sales. I expect my sales to be $16,800, but my sales are 6,100. Is that good for me? We're talking about sales now.
No.
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 But if when we're talking about the cost, I expect my cost to be that much, but in reality, I'm spending $16,100. Is that good for me?
Yes.
Yes. So you have to make that adjustment in your mindset. And you have to be careful. That's why it's very important you to understand what kind of variance I'm doing right now. On which element am I doing on the product cost or am I using on the sales? And when I'm doing on the product cost, which product cost actually I'm analyzing here? Now let's move to another question on the variances. So here. So now we did direct material and direct labor separately. Let's see this question now. Logistics Solution provides order fulfillment services to .com merchants. The company maintain warehouse that stock item carry by these .com clients. Okay, when the clients receive an order from a customer, in order to the order is forwarded to Logistics Solution, which pulls the item from storage, pack it, and ship it to the customer. The company uses a predetermined variable overhead rate based on the direct labor hour. Okay, so in the most recent month, 125 items were shipped to the customer using 4,400 direct labor hours. The company incurred total cost of 12,450 in variable overhead cost. According to the company standards, 0.04 direct labor hours are required to fulfill an order for one item, and the variable overhead rate is 290 per direct labor hour. Now, once we have this information, let's go back to our product cost. Which one of those we're chasing now?
Variable overhead.
Variable overhead. Is it clear for everybody? Is it clear for everybody
Yes.
that in this question we're gonna have to chase variable overhead and variable overhead only?
Yes.
I know it sounds like a direct labor hours, but direct labor hours are only used to come up with the predetermined overhead rate. That's all. So once we're using this, what we have to do, I'm gonna grab this line only, and I'm gonna post it here, and we're gonna start working with this question. Once we have this information, we're gonna use, since we're using the direct labor hour as a driver, we're gonna have the same abbreviations here: actual hours, actual rate, actual hours, standard rate, standard hour, standard rate. And we're gonna start one after another. What's the company? First question asking is, what's the standard labor hours allowed to ship 125 items to the customer? What's the standard variable overhead cost allowed to ship 120 customer? And what's the variable overhead spending variance and variable efficiency variance? Let's start our calculation. Let's pretend that we haven't seen those questions, and let's start plugging the information that we have. Now the question is, what's my actual usage of hours?
4,400.
44123. What I can use is, actually I can use this thing, the entire thing, And I'm gonna flip it here, and that's gonna save me a lot of time here. The only thing is I'm gonna delete some of the numbers. And I'm gonna plug those numbers later. Okay, so my actual hours is 4412, 4,400. Do I know my actual rate?
Yeah.
Not explicitly, but indirectly I can get it, right?
Yes.
Because what? Because I have my total cost, right?
Yeah.
Total cost is 12,540. And then my actual rate actually is going to be this one divided by 4,400, and my actual rate is 285. Do I know my standard rate?
Yes.
290.
Yes, 290.
290.
Okay. My actual hours, right? 4,400. Now I have my variance here, right? Which variance is gonna give me something which is this favorable or unfavorable? I supposed to spend that much, but I'm spending that much. Is this in my favor or
Favorable.
favorable? So in this case, it's favorable. Why? Because the cost simply goes down. With $220, let me grab one of those here and paste it here. That's my first variance. So what's the next thing? I have to figure out where's my production, correct?
Yes.
What's my production?
125,000.
125,000 units. And based on my standards, what my standard says, per unit, how much I need?
0.04 direct labor hours.
0.04 hours. So where will be my standard hours to produce those one? It's gonna be this one
Multiplied this.
time that one. I need 5,000 hours. So in reality, based on my standards, I supposed to spend $40,500. Is that how much I'm spending?
No.
No. Is that favorable for me now?
Yes.
Yes. So where is my overall variance? Favorable or unfavorable in this case?
Favorable.
Definitely favorable. Finally, we see everything in favorable. Okay, questions on this point? Any questions, guys? Any questions on direct material, direct labor, variable overhead?
All
Anything that
good?
you
All good.
see? All good? Let's keep going then. Let's move one level harder. If you can do this question, so let's see the next one. Now, this company, Dawson Toy Limited, produces toy called Maze. The company has recently created a standard cost system to help to control the cost and has established the following standards for the Maze toy. Now we have direct material, 6 microns per toy, 150 per micron. Direct labor, 1.3 hours per toy, $12 per hour, and $21 per hour. During July, company produced, let's separate those one. During July, company produced 3,000 made toys. The toys production data for the months is as follow. Now, direct materials, they use 25,000 microns were purchased at the cost. So we have here purchase at the cost 148. 5,000 of those microns was still in inventory at the end of the month. So the question is how many we actually use in our production. Make sense?
Yes.
In this case, we have to be careful when we read in the question because we purchased 25,000, but 5,000 of those 25,000 still in our inventory, so we haven't used them during July. So the question is, how many we use in July,
10,000.
right? So,
20,000.
and then we have direct labor hour, and direct labor hour were worked at cost of 88,000. So compute the following variances: material price and quantity variance, labor rate, and efficiency variance. So let's go back to question 3 when we're doing this calculation here. And let me get some of this calculation. And let's work with that. So first question, which variances we're doing here?
Direct material and direct labor.
Direct material, direct labor. So now we have to do 2 of them. So in your questions, on your exam, you always have to do 2 of them. Let me see, is there any question? So one question that you're gonna see is how to do you have to do direct material, direct labor, combination of those 2. The next question you have to do the direct labor, variable overhead variance. Those are the 2 questions. And there's a third question on the fixed overhead variance. But we're gonna come to that one a little bit later. So there are always going to be 2 variances that you have to do on the questions on the exam. Again, first will be direct labor, direct material, direct labor. Second one will be direct labor, variable overhead. So let's go with the first one. Now, since we have difference between purchase and usage, you have to split the variances for the price and the quantity. Make sense?
Yes.
That's the first thing that you have to keep in mind. If you see the difference, and you're gonna see the difference between purchase and usage, because that's the point of this question, you to be able to identify how much I'm purchasing versus how much I'm using. So let's go first with the first one. How much we actually purchase. Let me delete this one. I don't need this one. And I don't need this one. Those calculations can stay. Actual quantity, how many we purchase? How much material? We staying with the material.
25,000.
We pay 25,000.
25.
And we pay cost that we pay 1.48.
40.
So in this case, we don't have the total cost, so we're going to come up with the total cost. That's not going to be a big issue here. That will be equal to 25 times 1.48. Okay, we have this. What's our standard price? Based on our standard, how much are we supposed to pay?
1.50.
1.50. Actual quantity is 25,000.
25,000.
Right? So, and then we're going to have our first variance. And how much is our first variance? Is it favorable or unfavorable?
Favorable. What is it?
That will be
Favorable.
favorable, right?
Favorite.
And we can easily sense it's a favorable. Why? Because the quantity is the same. What changes?
Price.
Price
Price. How much the price changes?
down 2 cents,
2 cents
Down
times
2 cents.
25,000?
500.
500. Simple. Right? And that will be favorable here. Okay, so can I use the same 25 for my production?
No.
No. So in order to get my production, I have to copy those two and move it down here somewhere and start working again. But now I'm going to ask different questions. So my standard price is going to stay the same, correct?
Yes.
There will be no changes in my standard price. Standard price is going to be 150. What's going to change now? Quantity. How much I used, right? So I purchased 25, but 5 still sitting in my inventory. So that means how many I use?
20,000.
20,000 only. So based on the usage to produce my production, I'm supposed to spend, which is for my production, I'm supposed to spend 30,000. Now, based on my standards, how much we supposed to spend? So then we have to change how many we produce, right? Now we need that additional information here for the production. And our production was quite a lot, wasn't it? I meant this question or this different question?
This question.
I think it's the same question.
Yeah.
They produce 3,000 toys.
Standard cost, standard materials.
Yeah, because it's up there because it's
1,000.
rate 2 cents.
Standard cost per millimeters. So I guess I started the question from here. Really?
Yeah, that makes sense because that's the cost is the same right there.
So let's check quickly. Direct material, direct labor standard for the one. So we have the standard direct material 6 millimeters 0. Standard price
Like there
per
two
millimeter.
questions.
Standard.
This is a thing. It's about a like clean all spray, and the one we are doing is for the Dawson toys. So
Yeah,
it's
but
the
like it's
it's
two
like
questions
the,
there.
yeah, there are two questions, I believe.
There are two questions, right? Right, there are two
Yeah.
questions. Yes. There are two questions. Let's split them.
I think the twi one, yeah.
Yes,
Twi is a
let's
different
get
question.
rid of this. Let's get rid of this and let's check this question later. Let's get rid of this. I think I posted too many questions on the same sheet. Okay, let's get rid of this. We're gonna do this question a little bit later. So let's stay with our maze here because suddenly I'm start looking and say, what happened here now? Okay, so good catch. Let's keep going with these variances. How are you comfortable now with the variances? Are you getting comfortable?
Yes.
Yes.
Okay, so let's keep going. So now our production was
3,000.
3,000.
3,000.
Production is 3,000. 3, 1, 2, 3. And for our production, once we get the 3,000, what's the next thing that we need? Standard per one product, right?
6 micron.
6 microns per one. Per unit. Six microns. Good thing is everything is in microns, right? Imagine if Imagine if the question is they're using 5 grams, but they're purchasing 300 ton, right? then it become interesting. Let's see now. 6. So our production again is 3,000 times 6, and that's gonna be 18,000. That's gonna drive some kind of unfavorable variance, right?
Yes.
So what's our variance here? Obviously, it's going to be unfavorable since we're overspending. Why we overspending? Because we're overusing the materials. And that's going to be equal to this one minus that one. And in this case will be favorable or unfavorable? Unfavorable.
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 Clearly unfavorable, right? In this case, there's no questions about it. Clearly unfavorable. Now, the other question is, can I get the overall spending variance?
No.
Should I look at this one and this number?
No.
No. Why? Because we're different realities now. Don't forget that. So that was for the material. Now let's go and do the labor. For the labor, I'm gonna grab this chart from here. And I'm gonna flip it right here. So for the labor, we start to digging now information about labor. First one first. What's the actual hours work?
4,000.
4,000.
4,000. Let's start with the actual hour. 4,000. 1, 2, 3. What's our cons that we spend?
88,000.
88,000. Our standard rate, our actual rate that we pay our employees, 22,000.
Yes.
So, based on our standards, how much we supposed to pay them?
21.
$21. So, are we going to be positive or negative here? Favorable or unfavorable?
Favorable.
Unfavorable. Why? Because we simply pay them $1 more. Over 4,000 hours, 4,000 unfavorable. Right there. No questions about it. Now this will be unfavorable. We get that. Let's go and dig for the other one. I have my standard hours, my standard hours 21. What do I need? Standard rate, sorry. What do I need? We need our standard hours. Now, based on our standards, let's go with a little bit out here in some information. Insert. We know our production. Our production is still gonna stay the same, 3,000. But per unit, how many hours we supposed to spend per unit now?
1.3 years.
1.3 hours. Let's plug this 1.3 hours and see what's gonna happen. 1.3 hours. So in that case, my number here will be 3,000 times 1.3, and that's gonna give me 3,900 hours. So since I'm using more hours than my standards, what kind of difference that's gonna give me?
Unfavorable.
Or variance that's gonna give me? That's gonna give me unfavorable variance, right? How much unfavorable is? This one
2,100.
minus that one. 2,100 unfavorable variance. Does that make sense?
Yes.
Well, how many hours is the difference?
100.
100.
$121.
Yes.
There we go. So now we can talk about here about the overall spending variance, right?
Yes.
Now we can talk about this, and overall spending variance will be $6,100 unfavorable in this case. Sadly, but everything is unfavorable in this case. Okay, let's switch to this question, which is unnumbered question. Let's call it question 8. And probably that will be the last question that I'm going to do on the variances. Actually, that's again the material and labor. Let me see if this is different. Yeah, this is different question. On material and variance, let's do this on the material and the labor variances. So now the direct material and direct labor standards for one bottle of this spray are given below. And direct material, let's make it a little bit bigger here. So direct material is that much, direct labor is that much. 6 milliliters or 0.2 per milliliter, or standard cost is 1.2. So it's very important for you to understand that this information here can be misleading. Do you understand this? Can you sense this? The standard cost that you have, it might be misleading, it can be misleading information. What they're hoping is you to hang on this information and use this information for the standard rate and standard hours. Standard rate, which is neither of those. This is just if you use 6 milliliters and cost you 0.2 per milliliter, naturally the cost will be 1.2 for one product. But that's all. So let's see now. Here in this question, obviously we have to do from the variances that we have. We have to do direct material, direct labor, correct? Nothing else. So let's start one after another. I'm gonna go to the direct material first that we had, which is right here. And in this case, I don't think there's a difference between the purchase and the usage, but we'll see. If there's a difference, then I'm gonna adjust it. Paste it, okay. So I don't need this one for now. And I don't need this. So let's start working with our case. During the most recent month, the following activity was recorded. 20,000 milliliters material purchase as cost of 0.5. All the material was used to produce 3,000 bottles. So again, we don't have difference between the purchase and usage. For the materials, be careful on that one. 625 hours direct labor was recorded, a total cost of 10,000. Compute the direct material price and quantity variance per month and compute direct labor rate and efficiency variance per month. Let's go with direct material. We know how much material was purchased and used, correct? That will be 20,000.
Yes.
Next thing that we know is what's the actual price?
25 cents a milliliter.
25. Correct. So that's going to give us our actual cost. 5,000. Now that's the actual quantity is gonna come from here. Based on our standards now, how much we supposed to pay per milliliter,
20 cents.
right? So now you can see you can easily go 1.2. But even if you go with 1.2, you're gonna have a huge difference here. Make sense? So if you see some ginormous difference in the question or on the results that you're preparing based on the questions, ask yourself, am I missing something here? So you have to be the one who have to make that judgment call and go back to the information and see, did they pick the right information? I'm not talking about in this class, in this particular class, and in this particular course in the exam. I'm not going to go with that level of trickness for you, but you may have seen this later in your life, especially when you go to CPA, for those of you who are going for CPA. And that's why they hoping, that's why they putting so much information. So if you don't know which information to choose, the chances you to pick the wrong information is very high. But even if you do that, then ask yourself, is this number make sense? And if it doesn't make sense on the first glance, then start chasing more information. You're doing pretty much the same thing when you go to the store and shopping in the store. Correct me if I'm wrong here. But when you're shopping in the store, you naturally somehow, or at least me, I don't know, maybe I'm wrong, but I'm assuming people who have this idea about accounting, you naturally kind of know how much you're spending. And when you go to the cashier, you approximately know, depends on what you're buying, obviously, but you approximately know where you should be your total. So when you check the receipt and the receipt kind of matching your expectations, that doesn't bring a sign of awareness or warning sign. But if you say, okay, I'm expecting the bill to be around 30, and suddenly bill is 60, you say, oh, what's happening here? And then you start checking, going back. Make sense? So try to develop that sense here in these questions as well. Or again, with the other courses. Just think logically sometimes. So 0.02, right? 0.2 only, 0.2. And that's going to give me that variance based on the actual usage. So my variance here is 1,000 negative. Does that make sense?
Yes.
Yes. Why it makes sense? Because we're supposed to spend more. Why? Because we're using more. The price of the material went up. With how much? With 5 cents. And over 1,000, over 20,000, that drives the difference of 1,000 unfavorable here. Let's see based on our standards, where we are on the standards. Where is our production?
3,000 bottles.
We produce 3,000 bottles. And how much is per bottle?
6.
6 milliliters per bottle. So we're going to have here 3,000 bottles times 6, which I'm going to put here in second. That will be 6 per bottle. And that should give us $18,000. Standard price is standard price. That's not going to change. And I have this 3,600, which drives another unfavorable variance. So on the material, I'm completely unfavorable, correct? totally, completely unfavorable here on the material. And there's nothing we can do about it. So the total overall spending is unfavorable, strictly and strongly unfavorable of $1,400. So now let's check the labor. What's happening with labor? For the labor, I'm gonna steal this calculation here and I'm gonna flip it here. For the labor, how many actual hours these people work?
25.
625, right? 625 hours. And how much we pay them? $10,000. So that gives us a rate of $16 per hour. Now, based on our standards, how much we supposed to pay them? 15 hours. So we're gonna have favorable or unfavorable variance?
Unfavorable.
Unfavorable. Why? Because we're paying them more. We're paying them $1 more. In fact, on 625 hours, that's going to give us $625 unfavorable variance. That's with the labor rate, with the rate variance. Now let's see how efficient we are. So what do we need? We need to get the production again. We have our production, and per bottle, how many hours we supposed to use per bottle? And per bottle, based on our standards, we're supposed to use 0.2 hours, right? 0.2 hours, and that's going to give us amount of 3,000
600.
times 0.2. That's going to give us 600. So that's not going to drive any favorable variance, does it?
No.
No, it's going to drive actually unfavorable variance, which is going to be for the amount of, let's see what's here for us, 375 unfavorable. So we are not good on the rate, we are not good on efficiency. So in overall, we totally losing money. And how much exactly we losing on this? In this case, we're losing $1,000. Make sense?
Yes.
Questions? Questions at this point?
Good.
Okay, so let's go to the new question then. If we all good, let's go to the new question. Let's move now from these variances to something else. Enough with the variances. Let me find this question. Where is it? Continuation. Dalton. Okay, and this will be my paste. So now we're moving to completely different type of question. That will be question from chapter 11. So we're done with chapter 10. And the required here is the requirements here are first to compute return on investment of each division using the formula stated in the term of the margin and turnover ratio. Compute the residual income for each division. Assume that each division is presented with the investment opportunity that will have a yield of return 12%. If the performance being measured by return on investment, which division or division will probably accept the opportunity? And if the performance being measured by residual income, which division or divisions will probably accept that opportunity? That's what we have to do in this question. So we have two parts of the question. Let's deal with the first one first. Let's deal with the one that asking for the return on investment and then residual income. I'm gonna copy this and gonna move it right here. So this division has sales, average operating income, average operating assets, and operating income. Minimum required rate of return. That's perfect. Now we can have to see what's the return on investment of each of those. So in return on investment, they want to do it with the margin and turnover. So we have to each for this division to get margin and turnover. And once we get those margin and turnover, we can compute the return on investment. So now the question is, what was the formula for return on investment? Well, the return on investment is very simple. What you get operating income divided by average operating assets. But since we already know that this is a boring formula, what we're going to do, we're going to make it complicated. How are we going to make it complicated? By adding sales on both sides. So what we're going to do, time, here will be time, sales divided by sales. Sales divided by sales. And once we do that, we're going to make a formula look like here to be equal to operating income divided by sales time sales divided by average operating assets. And that's what we have to do. So margin, how are we going to get it? Operating income divided by sales. So in the first case will be 12 divided by 200,000, 0.6. Next one will be 0.5, and next one will be 0.5. Turnover in the first case will be sales
4,
divided by average operating assets.
4.
Here will be 4, the next one will be 2, next one will be 3. Return on investment, now we can calculate this one time this one. Oops. So it's equal to this one time that one. And that's percentage. C, Control C, and Control C. All right, so compute return on investment for each using the formula stated margin and turnover. We're done with this. Compute the residual income of each division. So in order to get that residual income, we have to remind ourselves what was the residual income. Residual income is we have to compare what's the actual income minus expected. And what do we expect? We expect to generate 8%, correct?
Yes.
From what?
From sales.
Is it from sales? From what we're expecting to get something? Think about people. Is it from sales?
Maybe assets.
From your assets? Make sense? You're investing, but you're not expecting a return from the sales that's going to be generated based on your investment. You're expecting return based on the amount that you invested. Make sense?
Yes.
Okay, so now let's see what's happening here. I'm going to copy this again. I'm going to paste it. Actually, I need to insert some more lines here. I'm going to copy this and I'm going to move it here. So, and I'm going to leave only the information that we need. Delete this one and we're going to leave this one, but I'm going to cut it from here. I'm going to post it here. So, this is how much we have in each division. This is how much we want. Minimum required rate of return. So what's the operating income that we want? So I want these guys to generate me 0.08%, right? So technically I'm waiting here for $4,000. Make sense?
Yes.
Yes.
So here I'm waiting for 12,000. Here I'm waiting for 10,000. What's the residual income on the first one?
$8,000.
I'm getting 12,000, but I wanted only 4,000. Wanting 12,000, but sorry, I'm getting 12,000, but I wanted 4,000, so I'm getting extra 8,000. How about the next one?
3.
3,000.
And the next one?
8,000.
875. Now, assume that each division is presented with the investment opportunity that yield rate of return of 12%. If the performance of the is measured by return on investment, which division will probably accept the offer? So let's see now. What's the return? What's the divisions? Control C. Actually, no, before I do that, let's put some space here. Let's get those divisions. Put it here. And let's get the return on investment that they currently have. That we calculated. But I'm going to paste it as numbers. Okay, I have my return on investment. Or let's make it practical for you. Let's make it equal to this number. And that case, this one's going to read from the other one. So, opportunity, we have, which give us 14%, 12%. Is this division going to accept it?
Dining.
No.
No. This is purely no. Is this division going to accept it?
Yes.
Yep.
12%. Clearly it's going to accept it, right? And the last one is the
No.
last division going to accept it? That
No.
will be yes, and that will be no here. That's based on return on investment. Now, based on the residual income, let's get those two again. We have this one. We have the residual income. Actually, division residual income. So residual income, we measure it by the minimum required rate of return, correct?
Yes.
So if that's my minimum requirement rate of return and I have opportunity of 12%, which one will be accepted?
All would accept.
All of them, right? That will be yes, and that will be yes, and that will be yes. So that kind of type of question you're gonna face on your exam. Again, the next question that you're gonna face on this exam is, I'm not gonna show it because I don't have much sample for those one, but you're gonna be given a kind of scenario about division, and you have to identify what kind of responsibility center that is. Is it a profit center? Is it cost center? Is it investment center? So I don't expect you to have problem with that. But if you think that you might have problem with that, please let's think about it, and let's talk about this next time. Now, what other questions I have for you for today? We did quite a few questions. How are we not? Those are all good questions. Okay, let's go with the decision making. Let's make some decision. Let me flip the question here. Question is gonna start coming. Just give me a second. It's kind of long question here, so I'm trying to put it on the few lines so we can see it, everything, all the information to be all together. Okay, that's pretty much the question. Okay. And the last part of the question is what's required. Now, this company Sato Awards has been requested for a special order. I told you you're going to have this, you're going to have special order. Yes, you're going to have special order question on your final exam. So the decision rule for this special order question is as long as the special order increase company profitability or add to the income of the company, go for it. So what that means? That means the company has to have the capacity first. Second, have the special order, the offer for the special order has to cover variable cost plus any additional cost that may have come from that special order. So let's see what this company have. Special order, they has requested a special order for 10 silver plates trophies for the Provincial Tennis Association. The normal selling price of those trophies is $249.95. And the unit cost is 164, shown below. Most manufacturing overhead is fixed, is unaffected by variation of how many trophies are produced in any given period. However, $7 of the overhead is variable, depending on the numbers the trophy produce. The customer would like a special logo applied to the trophy, require additional material cost of $6 per trophy, and would also require acquisition of special tool costing $195 that will have no other use once the special order is complete. This order will have no effect on the company regular sales, and the order could be fulfilled using the company existing capacity without effective any other orders. What effect would accepting this order have on the company operating income if the special price is $199.95 is offered by the trophy for this order? First question. And second, should I accept or not? So, okay, what do we have to do? How many we have to produce?
10.
10. Okay, how much is per unit? Sales price, how much they ask, how much they ask? 199, 95. Okay, what do we need? So the question is 199.95. Now the question here is, what do we need to produce those 10 units?
We need a tool that costs $195.
That will be the, let's go with leave the two the last.
Okay.
First, what do we need? We need to produce this product, correct? What's the first thing that we need?
Material.
Direct material. Start with the obvious things. Get the direct material first. So for those of you who's gonna go with the CPA, one trick for the CPA: start with the one that you know, and then keep going with the rest, because the chances you to miss one that you know are very high. If you not explicitly mention the one that you miss or the one that you're not certain about it, you're not going to lose that many marks. But get as much as you can. So direct material, how much direct material? $93. Okay, so the next thing, we are here per unit. Do you understand this? We are staying per unit. I'm doing this calculation per unit. Next one, direct labor. Do I need it?
Yes.
Absolutely.
Yes.
56. Okay, after this is obvious. After this, what else I need?
Manufacturing overhead.
How much?
Variable.
That will
7.
be variable manufacturing overhead. That will be $7. And what else I need? The special equipment, which cost me $195. So I need the special equipment to produce 10, correct?
Yes.
Equipment, which cost me $195. Now the question is, how much is per one product? Because I'm per unit here.
We also need the additional material.
So
to
how much will
listen.
be the equipment price per unit? With 195 that I'm gonna purchase, how many I can produce?
10.
10. So how much will be per one?
19.5.
19.5. 195 divided by 10. And that will be my total cost. Am I generating something? That will be my contribution margin here now, because everything is on the variable side and everything is product cost. Equal to this one minus this minus this minus this minus this. Boom. What shall we do?
Additional material costing.
Which additional?
The logo
Oh,
one.
the trophy require
The
additional
$6.
6. Oh, there we go. Let's add another one. Additional cost. You see, I forgot about this. $6. So that's going to reduce the price, but it's not going to change the overall dramatically the outcome, right? Minus 6. 1845. Shall we make it or not? What do you say? Are we making those 10 or no?
Yes,
Yeah,
of course.
of course. How much are we going to make total? Not much, but hey, still enough. 185, 184, 50 we're going to make. That will be the income that this order is going to contribute to our company. Make sense? Are you guys with me?
Yes.
Yes.
Yeah.
Okay.
So for this, it just matters that the order itself is making a profit, not whether or not the order is making more profit than like regularly selling
That's
items.
correct. That's correct.
Okay.
That's correct. The question is, yes.
I'm sorry. I have one thing to ask. So for the special equipment, we are considering here that as a variable cost, right?
Which one?
The special equipment. Like,
I shouldn't be considered as a variable cost. But I can, since I'm chasing the cost per unit, that's why, for that reason, I'm chasing as a variable cost.
okay.
But again, I'm just doing my calculation per unit here. If I have to be precise, then I have to go with the cells with the 10 units. And then it's going to be completely different story then. My calculation can be completely different. So my cells here will be, let me format this, guys. Let's grab this format and put it right here. So in that case, if I go with the total, sales price will be equal to 10 times 995. And this will be the amount that I'm going to generate. And then I'm going to have all those elements here. And then my direct material is going to be this one time that one. I'm gonna log this one now. And that will be my total cost here. And that's how I can avoid that special equipment. So the contribution margin that I'm gonna get or increase in the operating income is gonna be pretty much the same. Actually, exactly the same. Right? So these questions, again, based on the how the question guides you, you can go with per unit, or you can stay in the total. Anyway, you're gonna get the same result. If you're logically correct, you're gonna get the same results. Which method, how are you gonna come up with the answers? It doesn't matter. But you're gonna end up on the same answer. That's the beauty, one of the beauty of the managerial accounting. That's one of the beauty of this special orders and those decision making. Because different mindset, different thing. But one thing that I want you to remember, if you go to the unit level, stay with the unit level. Don't try to mix total with the unit. That will confuse you. If you decide to stay in the total, like you said, how about the special equipment cost? If you include it as a total, you include all the other costs as a total too. So you can be in the same reality.
Okay.
Right? Keep that, put that in your head when you're doing with the managerial accounting and anything in your life when it comes to the how the cost behave as a variable and fixed. If you decide to go per unit, stay per unit only. And if you see total cost, think about how much is per unit. Even if it's fixed cost, you can come up per unit based on the level of production. But if you decide to stay in the total, then convert the variable cost in the total to make, in order to make the correct decision. Okay, the way it looks, that will be the last question for today, which is not bad. We cover a lot today. We cover chapter 8, we cover chapter 10, we cover chapter 11, and we start with chapter 12. So for the next time, we have to cover only chapter 9 and a few more questions on this. And I'm gonna see, is there anything tricky in the exam so I can give you more hints. So this calculation sheet obviously is going to be posted for you, obviously, and you're going to have access to it with the calculations and everything the way it is. And yeah, you can enjoy it, guys. So where it's going to be posted? It's going to be posted on final exam review questions. So let me save it first before I let you go.